financial markets just delivered that, sent shockwaves through trading floors worldwide, and what we witnessed represents something far more sinister than a simple market correction. Right now, across every trading terminal, screens are painted in crimson as precious metals experience a bloodbath of historic proportions. Silver has plummeted to levels that seem almost incomprehensible, shedding value at a pace that defies conventional market wisdom. The white metal is currently trading at a price point that represents a staggering decline, hemorrhaging over 8% of its value in mere hours. But this isn't happening in isolation. Gold, traditionally the fortress of financial stability, has suffered a simultaneous collapse that reveals the true nature of what's unfolding before our eyes. When both gold and silver crater in perfect synchronization, with a ferocity that seems almost orchestrated, you're not witnessing ordinary market dynamics. This is the telltale signature of a liquidity crisis, that terrifying moment when the financial system begins gasping for oxygen. This is when survival instinct overrides rational decision-making, when institutions stop calculating value and start calculating whether they'll exist tomorrow. The precious metals aren't being dumped because investors have suddenly lost faith in them. They're being liquidated because they represent the last liquid assets available to pay mounting obligations. In this chaotic landscape, understanding the mechanical forces driving this destruction becomes the only compass for navigation. The anatomy of this crash reveals a brutal truth about modern finance. Consider the predicament of a massive institutional player, drowning in leverage and facing a margin call that demands billions in cash within hours. They survey their portfolio with desperate eyes. Their bond holdings are frozen in an illiquid market that's simultaneously imploding. Their private equity stakes would take months to unwind. But precious metals? Those can be sold instantly, 24 hours a day, to a global network of buyers hungry for liquid assets. So they slam the sell button, dumping billions worth of gold and silver contracts into the market in seconds. This isn't a considered investment decision based on fundamental analysis. This is financial triage, selling whatever bleeds the least to save what remains. The disparity in market size between gold and silver creates an amplification effect that devastates silver holders. When the liquidity vacuum strikes, silver's smaller market means it falls harder and faster. The volatility multiplier kicks in with brutal efficiency. Industrial demand hasn't evaporated overnight. Technology companies still require silver for battery production. Solar energy infrastructure still needs silver paste. Military contractors still need silver for advanced systems. None of these fundamental demand drivers disappeared in a single trading session. What vanished was financial liquidity, and that temporary absence created a pricing distortion of epic proportions. The dollar's role in this drama cannot be understated. Typically, when commodities crash, the dollar surges. In crisis moments, the global financial system reveals its deep-seated addiction to the American currency. Banks hoard dollars, lending freezes. Foreign currencies get sold, assets get liquidated, all to accumulate more dollars. This purchasing frenzy drives the dollar's value upward. And since silver trades in dollar-denominated contracts, a rising dollar mechanically suppresses silver prices. The profound irony is that investors flee into the very fiat currency, whose unlimited creation caused the underlying instability. They're selling the lifeboat to buy passage on a sinking ship, simply because that ship offers temporary comfort and familiarity. This dynamic unleashes a deflationary shock that rips through every asset class. Stocks tumble, cryptocurrencies crater, oil prices collapse, silver gets crushed. The only asset class rising is cash itself, as its purchasing power temporarily expands. This environment represents maximum danger for leveraged investors. If you borrowed money to purchase silver, convinced the rally would continue indefinitely, the sudden price collapse annihilates your equity position. Your broker liquidates your holdings at the absolute bottom to recover their capital. You're left with nothing but losses and regret. Then, typically once the acute crisis passes, central banks respond with their standard playbook of monetary expansion. They flood the system with fresh liquidity and silver rockets to new heights. But those who got liquidated missed the entire recovery. They were ejected from the rocket on the launch pad, watching it ascend without them. The psychological trap that ensnared many traders reveals itself in the price action. Early in the session, silver appeared to be breaking out toward new highs. The chart looked pristine. Momentum seemed unstoppable. Retail traders chased the price higher, convinced they were witnessing the beginning of an epic squeeze that would drive prices past triple digits within days. Then the trap sprung with violent force. The liquidity event hit like a tsunami. Heavy institutional selling crashed through support levels as if they didn't exist. The price sliced through successive thresholds, triggering cascading stop losses that added fuel to the inferno. Selling begat more selling in a vicious feedback loop. Those who bought the breakout now sit on devastating losses, watching the carnage and wondering whether to capitulate and preserve whatever capital remains. The responsible path forward requires acknowledging the danger of trying to catch falling knives. When markets drop this aggressively in a single session, they create structural damage that takes time to repair. Support levels that traders relied on have been obliterated. Sentiment has shifted from euphoria to despair in hours. Further downside remains possible as volatility tends to cluster. Big moves often beget more big moves. The market might test even lower levels as the selling pressure fully exhausts itself. However, for those holding physical metal rather than paper contracts, the strategy crystallizes with remarkable clarity. Do absolutely nothing. Resist the urge to panic sell. You own the actual metal. No broker can issue you a margin call. The price flashing on screens represents the paper market where distressed institutions dump contracts to raise emergency cash. It's not the real-world price of the physical metal in your possession. The disconnect between paper and physical markets provides perhaps the most telling signal of all. Despite spot prices collapsing, the premiums dealers charge for actual coins and bars likely haven't dropped proportionally. Dealers understand that physical metal remains scarce regardless of what's happening in the futures market. They'll probably widen their spreads substantially. Spot might indicate one price, but try buying actual silver at that price and you'll discover the true cost is significantly higher. This divergence screams that the two markets are fracturing. The paper market is imploding while the physical market freezes. Smart money wants to be positioned on the physical side of that break when it becomes complete. The question everyone asks after a crash like this is whether the bull market just ended. Did we just witness the top? Or does this represent a violent but ultimately healthy correction that clears the excesses and sets the stage for the next leg higher? History suggests that straight-line moves prove unsustainable. Markets need corrections to remain healthy. This correction was brutal and terrifying, but it accomplished the necessary task of resetting expectations. The leverage has been purged from the system. The euphoria has evaporated. Now the market can do the hard work of building a sustainable uptrend based on fundamentals rather than speculation. The gold decline deserves particular scrutiny because of what it signals about systemic stress. Gold represents the apex of the monetary hierarchy, the asset you liquidate only after exhausting all other options. It's the emergency reserve you access when everything else has failed. So when gold gets sold this aggressively, it indicates that high-quality collateral is being liquidated under duress. The likely culprit is stress in the bond market. When bond prices fall, the value of collateral securing the entire banking system deteriorates. Banks use government bonds as collateral for loans. If those bonds are worth less, banks demand additional collateral or cash. Borrowers who can't meet these demands are forced to sell gold to raise the necessary funds. When gold drops, algorithmic trading systems automatically sell silver because the metals trade as correlated pairs. This is how contagion spreads, dragging silver down due to problems that have nothing to do with silver's fundamental supply and demand dynamics. This proves frustrating for silver investors who did thorough research and correctly identified the supply shortage. You analyzed the market properly. You understood the fundamental drivers. But you're losing money because a bond trader on another continent made a leveraged bet that exploded. However, liquidity crises tend to be short-lived precisely because central banks cannot permit them to continue. If the bond market crashes, governments lose the ability to fund themselves. If collateral chains break, banks fail. So central banks must intervene decisively. They will slash interest rates, inject liquidity, and do whatever proves necessary to stop the bleeding. And when that fresh money floods into the system, where does it flow? It rushes into the assets that were most unfairly punished during the panic. It flows into gold. It flows into silver. The crash creates the setup for the stimulus, and the stimulus provides the fuel for the next rally. Modern markets are dominated by algorithmic trading systems that follow trends mechanically. For weeks, these algorithms were long silver, buying every dip and driving prices higher. But today's sharp decline triggered trend reversal signals in their models. So they flipped instantly, going from maximum long positions to neutral or even short in mere hours. They dumped enormous quantities of contracts without any consideration of fundamentals. This is mechanical, emotionless selling based purely on mathematical formulas. The algorithm doesn't know about physical shortages or industrial demand. It only knows the price crossed below a moving average. This creates massive overshoot to the downside. The price falls far below what fundamental reality would dictate, creating an artificial discount. Human investors who understand the physical shortage have an edge. Eventually, physics defeats mathematics, but in the short term, the algorithms have more firepower. The physical market provides a floor beneath which prices cannot fall indefinitely. Major buyers in Asia were paying substantial premiums above Western prices. Now that the Western paper price has crashed, the arbitrage gap has widened to extraordinary levels. For every ounce of silver available in New York, there's a massive profit opportunity in shipping it to Shanghai. This gap functions like a bungee cord. The further the price falls in the West, the tighter the cord becomes. Eventually, the tension snaps the price back upward violently. Unless Asian demand has also collapsed, which seems unlikely given strategic imperatives, the floor holds firm. In fact, a Western price crash might accelerate the physical drain. If silver is suddenly on sale in New York, Asian import data will likely show record volumes as strategic buyers use this dip to acquire as much metal as possible. The chart structure looks damaged after such a dramatic decline. Technical traders will interpret the massive red candle as a bearish signal and pile into short positions. They'll feel confident that the top is confirmed and more downside is coming. But in secular bull markets, bearish patterns frequently fail. They transform into bear traps. If the price stabilizes at current levels and holds for several days, those bears who shorted into the hole will grow nervous. They'll need to cover their positions, and that short covering will spark the next rally. The market is currently in a redistribution phase, transferring ownership from weak speculative hands to stronger hands that understand value. Users of silver don't sell, they accumulate. As ownership shifts from speculators to end users, the free float of available metal continues shrinking. Tax considerations add another layer to year-end selling pressure. For taxable investment funds, realizing losses before year-end offers strategic benefits. If they bought silver recently at higher prices and sell now, they book tax losses to offset gains elsewhere in their portfolios. Then they can repurchase after the required waiting period or immediately buy proxy assets. This tax loss harvesting creates artificial selling pressure that disappears once the calendar year changes. The sellers vanish on January 1st, the buyers remain. This dynamic is one reason year-end often marks pivot points with bullish reversals in January. The crash is frightening and painful, but it's mechanically understandable. This is a liquidity event driven by external factors in other markets. It's amplified by algorithmic trading and year-end tax selling. It's cushioned by physical demand and international arbitrage opportunities. The fundamental thesis that global silver supplies are inadequate to meet demand hasn't changed. Industrial applications still require silver. Military systems still need silver. The monetary system's debt burden continues growing. Today's price action represents violent noise, but it's ultimately just noise. The structural deficit remains. The physical floor concept deserves emphasis. At some price level, the arbitrage gap becomes so wide that physical market simply overwhelms the paper market. We're approaching that critical threshold. Mining companies face a dilemma as their stock prices crash, despite unchanged fundamental profitability. Even at current prices, these companies generate enormous profit margins. Their production costs remain stable. They're making dozens of dollars profit per ounce. A one-day stock price crash doesn't change the cash accumulating in their bank accounts. The stock market is reacting emotionally, pricing miners as if silver is returning to previous decade lows. But if silver remains near current levels, the upcoming earnings reports will show spectacular results. Price-to-earnings ratios will compress to single digits. This creates a value proposition so compelling that value investors cannot ignore it. The disconnect between stock prices and cash flow reaches historic extremes, creating tension that typically resolves with explosive rallies. Liquidity crises follow predictable timelines. Recent history shows these acute phases last days to weeks, not months. The system cannot tolerate prolonged deflation. If asset prices remain depressed too long, debt collateral fails and banks become insolvent. Central banks are forced to react quickly. We're likely looking at days of chaos before the calendar turns and liquidity returns. Once central banks signal support, recovery often proves as violent as the decline. Silver could test lower levels this week and return to recent highs within days. That's the nature of thin markets. They overshoot dramatically in both directions. Contrarian analysis provides crucial insight. When everyone feels euphoric, worry. When everyone feels miserable, opportunity emerges. Sentiment flipped from greed to fear within hours. This typically signals a bottom is forming. Markets bottom on fear and top on greed. The fact that people are panic selling and declaring the bull run dead provides the fuel for turnaround. Weak hands have capitulated. The market is cleaner and ready to rise. Geopolitical risks provide another wild card. While markets crash, global tensions continue simmering. Any headline about conflict or supply disruption could trigger instant reversals across commodity markets. In liquidity crises, traders forget about geopolitics and focus on immediate cash needs. But real-world risks don't disappear. Silver remains the hedge against those risks, and selling your hedge because of temporary price weakness proves counterintuitive. Short sellers profited handsomely from today's decline, but greed often leads them to overextend. They see the price falling and assume it will continue, so they add to positions using their profits. This reloads the squeeze potential. If they fail to cover and the price reverses, they become trapped again. The cycle repeats. Squeeze, crash, reload, squeeze. We're in the crash phase. The reload comes next. For those holding physical metal, today was essentially a non-event. Your coins didn't shrink. Your bars didn't vanish. You still possess the same number of ounces. The only change is the number of currency units a panicked banker offers you. Why would you let a distressed seller determine your wealth's value? He's selling because obligation forces his hand. You face no such compulsion. You have the luxury of time. He has a margin call deadline. He's distressed. You're patient. Fundamental scarcity hasn't disappeared. The crash represents opportunity, not catastrophe. History teaches that flash crashes within bull markets prove temporary. Significant single-day declines have occurred repeatedly in previous bull runs, only to see prices making new highs within weeks. Why does this pattern repeat? Because liquidity crashes are artificial. They disrupt paper pricing temporarily and clear order books, but they don't alter structural demand. Technology companies don't halt production because hedge funds blow up. Government mints don't stop buying silver because algorithms sell. Strategic reserves continue growing. Physical demand remains constant. The paper price is variable. When paper prices drop too far below physical reality, they snap back like elastic. This creates the sharp recovery everyone recognizes. It happens because value investors with substantial capital step in. They see current prices as gifts, opportunities to acquire assets they missed at lower levels. Investing in silver tests conviction like few other markets. It's volatile, manipulated, and frustrating. It shakes out weak holders ruthlessly. It creates euphoria, then crushes it without mercy. That's the beast's nature. But surviving this volatility's reward is potentially generational wealth. Those who sold revolutionary companies during previous crashes because of massive drawdowns missed thousand-fold returns. Those who sold transformative cryptocurrencies during every panic missed extraordinary gains. You must accept looking foolish short-term to appear genius long-term. Today you might feel foolish for not selling at recent highs. Forgive yourself. Nobody catches exact tops. The goal isn't trading perfection. The goal is being right about the big picture. And the big picture remains clear. The verdict on this liquidity crash acknowledges the pain while recognizing necessity. It cleared leverage. It reset sentiment. It opened doors for institutional participation. Current prices remain extraordinarily elevated compared to starting points. Massive uptrends persist on weekly and monthly charts. Don't let one catastrophic day erase months of progress. Hold physical metal. Ignore paper market noise. Wait for liquidity's return. The system fired a warning shot, but the vessel keeps sailing. The destination hasn't changed. The journey just got rougher temporarily.